The Q2 performance was very strong, both on an absolute basis where the market was up north of 20%, as well as on a relative basis with the select strategy increasing roughly 40%. What was supporting the market performance in the second quarter was a continuation of what we saw at the end of March, where the market bottomed due to capitulation. We started to see throughout Q2 COVID cases flatten out and gradually calm down. And then we had a very supportive Fed that was printing money to support an ailing economy. And that fueled pretty much every sector across the board. The defensive sectors like utilities were some of the lagging areas. The most rewarding sectors were those that were companies and areas that leaned into growth and innovation, but still some of the value areas did very well as they bounced off the bottom as well. Without a doubt, some of the stronger performers in the portfolio were in those more innovative, disruptive areas within the portfolio. Companies like Shopify, Wix, Carvana, DocuSign, Mercado Libre, Livongo were all stocks that contributed quite significantly. With that said, though, the performance was quite broad, where we showed very strong performance in a number of sectors, with cash really being our biggest detractor during the period. We actually had over 10 stocks in the portfolio up 100% plus within the second quarter. The other area that did quite well in the portfolio are companies that were in the evolving opportunity set. These were companies that had improving trends where there was significant progress in the fundamentals of those businesses heading into this environment, where these companies had maybe struggled in the past and they were on an improving trajectory. And that continued right through the second quarter. So companies like a Crocs or VJ's, Lowe's were companies that weren't sort of eye of the storm companies, but had nice trends underway that really benefited both on the bottom line as well as the top line. We're finding a lot of opportunity in the market, even though we're in these choppier waters in the market and kind of trying to feel out what this reopening of the economy looks like. The pullback has created a lot of interesting entry points in companies that we started to do work on back in April and early May. And then when the economy reopened in early June, a lot of those stocks ran away from us. They're coming back down to those same levels that they were at earlier. And I think we do have a better picture of what a reopening could look like and the parameters around that, and how consumers and corporations are going to respond. And so we're revisiting a number of those names. We've started to accumulate some incubator positions in some of these companies, and we're looking to build those up over the coming weeks and heading into earnings season. So there's no lack of opportunity for us to be putting capital to work, and we're finding those opportunities today. The outlook from here is definitely murky. We have an elevated unemployment level in the double digits. We have a uneven reopening of the economy, which looks quite different depending on what city or state that you're in. And we also have a trade war that's heating up with China again, as well as, let's not forget, the election coming in November. So we continue to stay rather defensive in our positioning in the portfolio, continuing to overweight some of the more disruptive companies that are growing quickly and have a lot more company-specific levers that they can pull on, and shying away from more cyclically exposed businesses where we feel those companies have less company-specific drivers and less things that the management team can do to continue to outmaneuver and navigate these choppy waters in the coming months and quarters ahead. So we see a number of positive signs, but I think the outlook still remains pretty murky, and that's why we're continuing to lean on those company-specific stories.